The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Let's jump in and go back to, I suppose, discussing time horizon with our own objectives as financial traders. Okay, given the short-term volatility in financial markets, and of course, depending on the trading style of individual traders, many traders unfortunately forego the best time horizon trading opportunities in favor of scalping or intraday swing trading. Now, that is absolutely fine. If you are scalping and swing trading or one or the other, and you are allowed, say you have a downside of 100 euros per day, and that is your limit down day, I suppose, which we would call in the proprietary futures world, specifically for trainees. Your limit down day is 100 euros, of course, but if you're able to have one limit down day over each week and effectively outperform the markets on 4 other days, well, that's fantastic, because you're effectively beating the market and making money in trading. So the point of this discussion is not to dissuade anyone to swing or move from trading strategy. If it works, do not move across. But you'll find with your experience that you'll look for these opportunities. And I'm going to highlight some very prevalent opportunities that have existed in the markets that we have actually traded here at Forex.Academy as well myself. And that's specifically just because I'm aware of how the markets move, and I know that there are some carry trades out there that are better opportunities as medium to long-term trades than trading intraday. So I need to understand that financial trading or portfolio investment, or portfolio trading, as I would call, takes on a time horizon approach. And this is the point worth mentioning, is that trading in the short term does not preclude you from engineering mid to long-term trading opportunities. Time horizon trading is not an action reserved for the global investment community. It also does not mean that we have to hold positions open for 3 to 6 months. That's certainly, or longer, that's not the case. A good trader will aim to diversify not only in asset allocation, but in eventual time horizon. Okay, so this is the point we're making, guys, that these professional traders, they get involved in the markets. They sit down with their screens at 7 o'clock UK time until 9 o'clock at night, of course trading the futures markets or some options, whatever suits the individual trader, and getting heavily involved when the markets are moving. And of course, when new news flow enters the markets, trading the cash close of 4:30 UK time, 5:30 European Standard Time, of course, and different opportunities that arise throughout the course of the day, whilst at the same time, let's say we believe fundamentally, we've studied the dollar yen, we think, well, it's overpriced, it's going to sell off, or perhaps the dollar is very strong at the moment and the risk on theme is starting to trickle back into equity markets. Therefore the yen will see some cash pull out of that as a safe haven currency. Let's get long the dollar yen, because it is fundamentally quite strong on the dollar side and starting to weaken on the yen side. That might be a theme that I want to follow for 3 months and trade that as such. Okay, so a good trader will aim to diversify not only in asset allocation, but in eventual time horizon. So let's take, for example, the following professional trader, Michael. Okay, Michael has been trading successfully for 14 years and has 3 separate active open accounts. He is a talented active trader and relies on his weekly revenue from short-term money making, I suppose, for his main source of income. So he's a scalper, he's a short-term day trader. However, as a trader, he involves his capital in both medium and short-term trading opportunities. He now has to incorporate a higher degree of diversification into his trading style as he aims to manage a portfolio of both medium and long-term carry trades. Okay, so why might this be of benefit to Michael? Well, here's the 3 accounts, of course. So his bread and butter, account number 1 is his bread and butter, perhaps over the course of the day, he scalps, he gets heavily involved in the market. He has, on this particular day, a trade count of 155 trades, so he's quite active. And you can see then he has a makeup in terms of trading different assets. So a good trader trades different assets as well. And let's say he has 155 trades in the euro US dollar. Is he going to be that consistent? Is he going to make money? And that would be extremely hard to make money having that trade count across few markets. Okay, so you look to stretch across where the opportunity lies. And you'll often find sometimes when you're staring at your trade screen, if you're an active trader, that nothing's happening, that absolutely nothing's happening, and you don't trade. That's fine. So we trade where we see opportunity. Anyway, Michael has on this particular day a trade count of 155, 27% Forex, 25% equities, 21% metals, 20% energies like natural gas and oil products, bonds. He only has 4% trading on the day. Cryptocurrencies 3% as well, so gaining some exposure to the crypto side there, the crypto space. His risk is obviously daily, considering he does this in resets daily, as his target is of course to make profit on a daily count active trading. Okay, so he risks only 1% of his entire count on any given day. Now on this particular day he traded 155 times and he returned a 1.5%, or his average, excuse me, is 1.5% return per day. So that is fantastic in terms of getting involved actively trading in the markets. He would have taken plenty of losers during this 155 trade count during the course of the day, but obviously has just outperformed the market in this particular day, and obviously his average is 1.5% average. Okay, so that's how that is, well, quite reserved, to be honest, in terms of trading quite actively like that during the day. But again, consistency is the name of the game. He has now branched into his account to medium-term profit targeting as well. So we've moved away from his daily short-term trading. The trade count is 12, so he has 12 perhaps potential long-term or sorry, medium-term trades here in terms of asset class diversification. What you can see, he has diversified quite well. So he's went into Forex there with 35% asset allocation, equities 40%, bonds 20%, and cryptocurrency again 5%. So he's getting some exposure there across different asset classes. His risk is 4.5% on his entire account, okay, on his entire trading account. Evidently with this, he actually only returns 4%, but that's still profitable, okay? He risks a total maximum exposure of 4.7%, but he doesn't meet, I suppose, his exposure, his ratio there, but he still outbeats the market. He still performs over the medium term. Perhaps they're monthly trades, perhaps he's been in those trades 2 weeks or 3 weeks, but effectively he's delivered a return of 4%, so that's great. Now, with his third account, it's only a long-term profit targeting strategic account. He only takes 3 long-term trades, one in the Forex market, okay? Equities, again, 60%. This might be down to trade size that he has in terms of his exposure, and bond markets again, okay? So the risk here is 5.5% he's looking to deliver on his account. The risk on his account. Evidently, he outperforms fantastically. He's made 9%. So you can see, guys, how he's gaining some exposure to those big trades, and effectively this is how he's making his money in the markets. What are the advantages to Michael's trading strategy? Well, Michael can take advantage of short-term volatility intraday whilst trading off long-term fundamentals, okay? Whilst trading off long-term fundamentals. So let's get into the practicality of this intraday trading. We have Michael's account here, and of course he had 155 trades. Again, we have just a sample of 15 trades, and let's compare it to Frederick and John. Again, question I would like to ask is which of the following traders is trading with practical diversification? So let's get into the nitty-gritty of his trading, and this is something we want to emulate, guys, okay? There is simply no clue here. This is something we want to emulate as traders, okay? So he has a very well-defined monetary exposure, okay? Given that he trades so much, I would say he's trading small trade size in each individual trade, but his monetary exposure for each individual trade is is only $10, okay, or €10 or £10. So very, very good in terms of monetary exposure. Intraday trading, we have monetary exposure here for Frederick, 20, okay, and then John as well, 10 as well. So very good. Okay, still quite consistent. Okay, let's go back to Michael then. We can look across. He is obviously outperforming the market greater than the other two guys, albeit they're both trading very well. Okay, and let's go back then to discuss the instruments here. Well, the first thing that we can see, guys, is that we are very practically diversifying this portfolio over this trading day very, very well. Okay, we have no information to understand whether they're short or long positions at this moment, but what we can see, guys, is that he has traded the US dollar CAD, he's traded Bitcoin, he has traded copper, the Euro US dollar, the UK FTSE 100, Netflix single stock, the US dollar against the ZAR, South African Rand, E.ON, an energy company there in Germany, US oil, of course WTI crude oil, Amazon, again a single stock equity, not in the same space as Netflix, online streaming or film and TV streaming. The dollar index, he's got some exposure in that again. He's made another trade in the US dollar ZAR again. They're both actually winners, so that would tell me that the US dollar is moving on this day. And again, the dollar index was one of his winners again, so he's captured momentum in this trade. The euro pound, again, he's actually taken a small loser in that, but again, it's not correlated. The New Zealand, Japanese yen, and the German DAX. Okay, again, we have three equity trades, equity indices trades. We have the German DAX and we have the UK FTSE 100. So two equity index trades. That's great. So that's two equity index. Then we have three dollar trades, and again, if you count the US dollar against the ZAR there, so $5 trades again. This is out of his 15. So in and out, some are losers, some are winners. So we can see the euro dollar there was a loser. So that would tell me that it could have been a hedge trade, short-term hedge trades. He's getting in and out of the markets, but he's taken his loser just before his £10 stop loss. So again, he has effectively taken other sides of the market here again. So a 5 Forex, let's say. Again, we've got some single stock equities, and we have some commodities in there as well with oil and copper. And again, we've got some cryptocurrencies as well with Bitcoin. So absolutely fantastic diversification, practical intraday diversification across his asset class choicing. Now, Frederick, when we move on, we can see that we have some poor risk management, of course, with not keeping the monetary exposure in place. So that's a no-no. However, let's focus on the intraday diversification. We have a euro pair. Okay, so that's euro. We have euro again here. Again, if we move we've got quite a few euro trades here again. So they're all correlated again. That's not to say, we've seen that Michael made many trades in the US dollar, but they were all quite well performing trades. So that would suggest that he's trying to capture this momentum in the in the dollar. Then if we look across the dollar space, we have, for Frederick, we have another dollar trade, another dollar trade. Let me see. There's yet another euro trade that I missed. Excuse me for that. Another euro trade, euro US dollar, evidently. Okay, so plenty of trades here in similar currencies. Okay, so this is starting to look, guys, that as if he hasn't diversified too much. And again, let's move across to a different market. What do we have in terms of sterling? We have another sterling market there. Okay, more sterling. Moving down, dollar sterling again, more sterling. Okay, so he hasn't hedged too much across the forex pairs, and they're all forex pairs as well here. We have, of course, one equity index which isn't correlated again, but he's been trading sterling quite often, but we'll give that a green tick. So he has gained some exposure in different forex pairs there, but again, you can see that it's a completely different level of exposure than Michael has taken on. So Frederick has outperformed the market again, but he hasn't properly diversified. So he's taken on that risk, and he's taken the reward of $77.99, but he has more likely taken on a substantial amount of risk more than Michael has to get to that level. Now let's look at John, and I'll just go through John quite quickly because it sticks out like a sore thumb. John is heavily invested in the US dollar here. We have all of his trades so far. Again, the S&P, okay, we'll give him that one, but it's still borderline within, you know, the movement of the dollar today. US dollar, okay, guys, so he's really trying to capture this dollar move again. He's really getting caught up in the chop here. So we can see, guys, that John is evidently not following practical diversification intraday. So that's a big no-no for us. So again, which of the following traders is trading with practical diversification? Michael is our winner here, and let's go into a little more detail to discuss how Michael is approaching these markets, because he is quite a talented trader, as we're finding out. So this was Michael's short-term account that we just looked at, okay? So we can give this a big green tick. Michael has, out of his 155 trades, he delivered a return of 1.5%. Okay, that's fantastic. Out of these 15 trades, he delivers a return of 97. Again, fantastic, with good correlation, good diversification across different asset class allocations. So fantastic work there, intraday trading. Now that is a short-term account. Let's look at his other profit opportunities. And again, well, we have some sterling markets. Okay, so we have sterling against the US dollar, and we have sterling against the Japanese yen. Are there any more sterling trades? We have again here sterling trades again. So that tells me that he has been a little overexposed, but it looks with his P&L that he's actually looking to take a short and long hedge trade on this position just by looking at the P&L. Okay, so perhaps he is trying to hedge the markets and try and diversify away some risk, but effectively he's running his winners. What you can see there, they are moving, so it depends on what's happening in the market this day. Again, we have the gold market, so a totally different market in terms of diversification, linked to the gold market, again to the commodity and the US dollar. Then we have the French CAC 40, so the French 40 there. Again, European equity, different. It's actually in the minus, so that might tell us that the euro might be a little flat on the day, or perhaps strong. Appreciating euro might pull the markets down just in terms of pricing. We have the cotton market, okay, very interesting, and the German 30. So again, we have a level of ambivalence here across the exposure to the euro space, the euro equity space. One is 22 in the minus, one is 22 in the positive. So he might be short and long one or the other, hoping that the German DAX may outperform the French market today. Okay, so we are getting a level of exposure, and again, remember, guys, this is effectively a medium-term account, so we can't just use the same expectations as our first short-term account here. Perhaps he's trying to trade the sterling weakness at the moment. Okay, Michael, on his medium-term account, he's trading to trade the sterling weakness, and he's short these markets. So he's short cable market. He is then looking to short this market again. It's just pulling back on him, and perhaps he is long the euro pound market again, trying to add some exposure to the euro, but also following some weakness in sterling. Okay, and then the European equity space trying to gather some momentum there, whilst obviously looking for an inflation hedge in gold. Very interesting. The cotton as well is completely diversified from those, and it's a very well performing trade for him. Okay, so this is a fantastic open account so far. Okay, but we're yet to see, these positions are still open. We're yet to see the success of this account. Now let's focus on his third account, the long-term trading account. You can see, guys, effectively what we're seeing is this is what you should be doing, of course, in terms of trade size and your selection. Okay, you can see really we have 7 open trades here and 15 out of 155 intraday trades, but they're completely not separate, nothing to do with his medium or long-term account. That's intraday trading. Then Michael has a long-term account with 3 open trades. Okay, 3 open trades. Now it's a long-term account, so we would assume that, well, we see some profit, we see some significant profit here of 308. So that's fantastic. However, let's have a deeper look at this. What is he trading? Well, he's trading US dollar against the Japanese yen. Perhaps again he's looking for upside in that. He's trading the FTSE 100. Again, there's a fantastic trade in this. and the US 10-year. Okay, so the US 10-year bond market, and that is effectively trading to the downside just. So he's gained some exposure across these asset classes, and these are long-term trades. So perhaps he's evidently choosing trades. He's thought fundamentally about the trade positions. That is the benefit, of course, to looking for long-term trade positions. If you have a hybrid approach of technical analysis and you're fundamentally believing, well, let's choose the US 10-year. Of course, at the moment it's providing yields over and above 3% for the first time in a long time. That is very significant for the market, and we're seeing that being welcomed by the investment community. So we're likely to see that with continued interest rate increases in the United States this year. In 2018, we're pricing in a total of 4 interest rate increases. Of course, we may see the yield certainly continuing to increase. That would mean the price goes down. Okay, so we're looking to follow that momentum to the downside. So we can see the level of exposure we are gaining here, or Michael is gaining for the benefit of having different trading accounts. Really, it relates to trading strategy. He is effectively applying a completely different trading strategy to account number 1, completely different account strategy to number 2, and again, a completely different account strategy to his long-term goals, opportunities that he sees opportunity in these markets, but not today, or he doesn't know what's going to happen and where the price is going to be in 2 days or in 30 minutes. However, he understands perhaps fundamentally that there's going to be a carry trade in the US dollar, Japanese yen, and he's getting involved. Okay, so it allows you to complexify your trading skills to look for opportunities. And again, guys, to be quite honest with you, some of you might prefer a hybrid approach of fundamental analysis and technical analysis, not looking to get caught up in all that intraday volatility. Some of us actually might forego all of this short-term intraday trading and perhaps have some, let's say 3 medium-term trades and 2 long-term trades. That is our portfolio of 5 trades in its entirety. Again, we might have a different time horizon for our first 3 trades and a different time horizon for our long-term trades as well, or our 2 long-term trades. So each individual trader is different in terms of how we assess the markets. If we want to use more fundamental analysis with our technicals, we can suggest, well, I'm not sure what's going to happen in the next week, but I know that the dollar will be, or the bond markets were here. I have a strong belief that the equity prices will rise over a long period of time. I need to define my risk, and I want to set out with a portfolio goal for that. Okay, so let's go into some more depth here to discuss long-term diversification. What we're going to look at is Michael's 3 trades. Okay, now they're still open positions, we know that, and the first is the long-term trade in the US dollar, Japanese yen. Why might he have traded this? Well, the US dollar sees an increase in demand across financial markets, allocating traders to capitalize on an appreciating dollar. Okay, so we're looking to capitalize on an appreciating dollar. So we have a long-term entry here from Michael. The market moves up, and you can see, of course, he has placed a stop loss in there, and just like his portfolio suggests, the maximum risk for all of these trades was 100 euros. Okay, effectively we have a floating profit there of potentially 210 to the good on this particular trade. Okay, so that's a long trade. That's a long trade in a currency, a forex currency carry trade. We see the equity markets perhaps rising, global growth. We see a technical break in the dollar in this trade. We can see, of course, the market pulls back today, but one thing that effectively Michael hasn't really done here, which we could suggest he should do. Guys, what could Michael do at this stage in terms of organizing his portfolio? Simon says mitigate risk. That's the correct answer. What I was looking for. Anyone have it there? Just throughout the lesson was revise his portfolio. Simon, so you're very close there. It's almost the same thing. In terms of practicality, Simon, you're correct. Look to mitigate that risk. He could move his stop loss up to this level. So again, he could revise his portfolio at this given time, looking to take some risk off the table. Perhaps now that this market today has created a new low, a structural low, he could look to bring it so the market doesn't pull back the whole way above that level. Okay, so absolutely, to mitigate risk of the trade or to revise his portfolio with the time horizon of his trade, or I could simply look to take profit. But again, that's a choice for Michael. Again, we're looking at the FTSE 100. Michael has decided to take a long-term trade in the FTSE 100. As the dollar appreciates, sterling depreciates, with the Bank of England holding off on interest rate increases. Interesting, because that's happened very recently. European equity prices are also being supported by global growth. Okay, so this is the trade that's happened very recently here. Mark Carney, the Bank of England, of course, governor, has suggested that, well, has pulled back with has increased his foreign forward guidance, and has really pulled back from giving guidance to the market that there's most certainly going to be a relatively new interest rate increase on the Bank of England there, the rate deposit. Okay. Now, the market had priced in this, of course, this interest rate increase. So we were looking at downside, of course, short-term downside in the sterling market, of course. So we've seen that continue, given that's the case. Now, what has happened here is there's a risk premium with sterling as the sterling market decreases. As the currency starts to depreciate, we see an uplift in the FTSE 100. Okay, so it's much cheaper in terms of pricing the stocks, and we see a trend forming to the upside. What has he done here? Well, we've taken perhaps a technical break again from such levels, and again, the fundamentals are stacking in with the trade. The second thing he does is place a stop loss, again consistent with his overall idea and risk on his portfolio. Floating profit is now at 401.88, so a fantastic trade in this market. Okay, and we're really seeing some outperformance in the FTSE 100. Now let's move across to his final trade of 3, and you can see how he has implemented this so successfully, guys. Well, effectively, because he has chosen to choose 3 trades that are completely different, guys. The US 10-year bond here we have on screen, the FTSE 100, and the carry trade in a currency pair, the dollar Japanese yen. Of course, we're looking to follow momentum. And again, what would support this trade? Well, an increase in demand for the US dollar currency is intrinsically linked to what's happening in the bond market as well. And the more demand for US Treasury bonds, the more demand there is for US dollars. So what Matthew has done is trying to compensate and follow this move. Michael has positioned himself to take advantage of the long-term trend whilst avoiding short-term volatility. We can see short-term volatility in the middle of the screen. Let me just point that out here. This, to us, represents short-term volatility to the trend. Okay, and that is not what we want in terms of just getting spiked out of a market that continues to go. So one way to do this is to not trade intraday, to take an overall view of the market itself. Okay, an overall structural view of the market to trade, guys. Now you need to be aware of the risk involved, and of course Michael is comfortable with his €100 stop loss on this particular trade. There's his long-term short entry. He's now short this market. The market is moving down with a very vivid, fantastic trend to the downside. And he has a floating profit there of 366.40. Okay, so he's effectively looking to trade the trend. He's not looking to trade profit. If he makes the trade and the profit moves down and shows him €50, he isn't concerned, guys, with let me see, where are we at on short? As he enters the market here and the market moves down, let's say we're at €100 profit here. But that's not the reason why he got into the trade. He had an idea about the trade. He wants to follow the long-term trend in the trade. He has a fundamental picture of what's happening in this market, what's causing the yield to rise in the US, and why this price, the inverse relationship to the yield, of course, is moving to the downside. And again, he doesn't know where this is going. He's not simply taking profit at price here, although it's a fantastic winner. He has an idea where this market wants to go. Now, of course, he could look to mitigate this risk, maybe to these highs here, given the market has traded so strongly to the downside. Of course, he could revise his portfolio. That is a question for Michael, but he has effectively, guys, provided long-term diversification across 3 uncorrelated markets there, and gaining some dollar, whilst at the same time gaining some exposure to US dollar denominated assets. So very well positioned in the markets he is, Michael. Okay, Now, that brings us to the end of our Become a Pro course with diversification. Let's discuss what we may have learned, of course, and a key factor I want to leave you on. Diversification does not eliminate the risk of experiencing investment or trading losses, okay? It simply does not eliminate the risk of losses. Government bonds are guaranteed by the full faith and credit of the United States government, or of course in the UK and Europe, given the climate to which your bond trading is, as to the timely payment of principal and interest, while stocks are not guaranteed and have more volatility than bonds. Okay, so I'll leave you with that note. Diversification, guys, it does not eliminate risk. We look to hedge and mitigate that risk through asset allocation, through diversification. We can build our portfolios both in the short, medium, and long term to do that as well. And that helps us not with just asset diversification, but in diversification to our own trading strategies. And we can then find an alpha between our, for example, Michael's 3 accounts. We have a level of performance for all of those 3 accounts. We can obviously quantify and average those out to find our trading alpha, or risk of return for the amount of risk we take as a trader. Okay. So that does bring us to the end of this Become a Pro course lesson, of course, diversification. We have now finished webinar 15, guys. We're on our way to becoming a professional trader. I'd like to go on this very sunny evening, and I will see you tomorrow then for the same time. Tomorrow, of course, we have to look forward to developing our own trading strategy, and it's going to be a very hypothetical, enjoyable lesson discussing many different types of trading strategies, both combining fundamental and technical analysis. So look, thank you very much for joining us here at Forex.Academy. I hope you did enjoy today's lesson. I'll see you tomorrow and look forward to that. And thank you for joining us. We'll see you next time. Bye for now.